Hi, this is Chuck Hughes. In today's video, I'd like to discuss option spreads versus option purchases. Many of you may be familiar with purchasing options, and that's a great strategy. If you can pick a good stock and it goes up in price, you can get a really good return from an option purchase strategy. However, over the last several years, I found that the increased market volatility makes it very difficult during different periods to profit from option purchases. I like to maintain a money management discipline, and I will usually exit an option trade if it loses around 30%. So it doesn't take much of a stock move in the underlying stock to create a 30% loss in an option. A 5 or 10% move in the stock could give you a 30% loss in the option. So the option purchase strategy is sometimes difficult to trade in these volatile markets because you can easily, on any given day, get stopped out of your option trade. So what I've done over the last several years is if I make an option purchase and I have an open trade profit, I will normally go ahead and sell a call option to create a spread with my option purchase. And the option spreads have several advantages versus the option purchases, which I've listed here. There's an increased profit potential. The option sale provides downside protection, reduces risk, and allows you to maintain positions during volatile markets. Now, this is a very important advantage with today's current volatile markets. And the last advantage is spreads can be profitable if a stock goes up or down. So let's take a look at each one of these advantages individually. Here's an example of an option spread trade I recommended to my advisory service members. We purchased the Conoco January 12.45 call option at 15.35, and Conoco stock went up in price, and when we had about a 28% return on the option, I went ahead and recommended the sale of the Conoco January 12.67.5 call option. So this created a spread with our original option purchase. And when this spread trade was initiated, this increased the profit potential of that call option purchase by 72%. When you sell an option to create an option spread, it creates downside protection in the event the underlying stock goes down in price. The short option, of course, profits as the price of the stock goes down. So I'm displaying the call option spread analysis for the Conoco option spread, and this calculator calculates the potential return for the option spread based on the price of Conoco stock at option expiration, and in this example from a 20% increase in the stock to a 20% decrease in the stock. So I circled there if Conoco stock remains flat at 76.42, which is the current price of the stock, this spread will produce a 151% return. And if Conoco stock declines 20%, the spread will still produce an 80% return. So the option spreads, because of this downside protection, they can still profit if the price of the underlying stock goes down. When the option spread was created, it also reduced the risk of the original call option purchase, and we originally purchased the Conoco January 45 call at 1535, and when we sold the January 12 67.5 call at 640, it reduced our cost from $1,535 to $895. So the sale of the 67.5 call at 640 resulted in $640 of cash being credited to your brokerage account for each contract. So it lowers your dollar risk. One of the big advantages of the option spread strategy is that it allows you to maintain your position during volatile markets and wide price swings in the underlying stock. With today's volatile markets, if you just own the option, it doesn't take much of a downside move in the underlying stock to get you stopped out. And with the option spread strategy, the short call option, of course, profits as the price of the stock goes down. So that downside protection in most cases will allow you to maintain your position during a volatile price swing without getting stopped out. And lastly, one of the big advantages of the option spread strategy is that you can profit if the underlying stock goes up, down, or stays flat. And I'm displaying the call option spread analysis return potential for the Conoco spread, and we can see from the call option spread analysis that if Conoco stock goes up in price, the spread will produce 151% return. If Conoco stock stays flat at the current price of $76.42, the spread will produce 151% return. And if Conoco stock drops 20%, the spread will still produce an 80% return. So this is a big advantage of the spread strategy, where the spread can profit if the stock goes up, down, or remains flat. And of course, with an option purchase strategy, you lose money if the option, if the underlying stock stays flat or goes down. You lose money on an option purchase strategy. So this is another advantage of the spread strategy versus the option purchase strategy. I'm displaying one of my brokerage account profit loss reports, and in this brokerage account I had a diversified portfolio of option spreads, and in this account the option spreads produced a $175,000 profit and had an average return of 95%. I make option purchase recommendations through my Inner Circle advisory service, and typically when these options produce a profit, I'll go ahead and sell a call option to create a option spread. And this has worked out real well during the current volatile markets, and I'm displaying the current option spread portfolio for these option purchases that were converted into spreads at a later date. And we currently have over $61,000 in profits and an average return of 194%. So this strategy obviously is working very well in the current market conditions. If you'd like to see the updated profit results for the various Inner Circle option strategies, just log on to chuckhughesic.com and click Trade Results. This is Chuck Hughes. I want to thank you for listening, and I wish you the best in investing success.